From a professional soccer career to becoming a driving force in the mortgage industry, Brian Covey has shown what it takes to find your competitive edge. Get off the sidelines and get in the game. Find your competitive edge with Brian Covey.
What's up, guys, and welcome back to another edition of Finding Your Competitive Edge. So today, we're honored because not only did I get to meet our guest 2 years ago at one of the mastermind and events out in California, but this is somebody that I have followed for my own personal, just learning and education around building your wealth, making sure I know what's happening in the economy. And Rob has been featured not only on Wall Street Journal, on CNBC, he's got Fox, Bloomberg, USA Today, his new book, Close Your Wealth Gap. We're going to talk about some things for you, no matter where you are, that you need to know what's happening in the economy. You need to know what are some of the smart investments. And also, man, let's help you not make some of the same mistakes that I know I made growing up. And I wish I had had someone like Rob Luna in my corner helping me make better decisions earlier in my life. So we're going to jump into all that and more. Guys, buckle up. Make sure you grab a pen and paper. Let's get going. Rob, welcome, my friend.
Thanks for having me, Brian.
Dude, well, you're in Nashville. So I got to start there because you moved from California not too long ago, a little over a year, right?
Actually, we moved here. We bought the house, I think, in January, but I didn't move here till March, so not even a year.
Okay.
Yeah.
I remember when you guys were here looking.
Yeah, we started looking last year. And I mean, the truth is, I had never been to Nashville until a mutual friend, Brian's event, the beginning of last year, 2022. And it was one of those things, I came out here, my wife and I are like, this is a great place, but can't be that great. We're on vacation. So we made a few more trips out here, started looking outside of Nashville, and just kind of fell in love with it. It was falling in love with it in a combination of California starting to hate what was going on there that drove us here this year.
Yeah, we've seen, I think, on our street alone in Franklin, Tennessee, we probably have 5 neighbors out of like 20 that have moved from California, and they've said the same, and it's this great little town. But tell us a little bit about, so you got married not too long ago as well.
Yeah, 2 years ago. Next week.
So you've had some big events. I kind of looked at that and I was prepping. I was like, man, you're going through all this and throughout what's happening in the economy and all that. What really, for you, made you guys want to make that move and kind of settle into Nashville? Because I know some people listening here are like, okay, man, what's different than California and Nashville? Just big picture.
Yeah, well, it's completely different. I mean, we lived in Newport Beach and we were literally one house off the water. So It was one of those challenges to where, okay, we knew the summers were going to be hot. But, I will say I lived in Arizona for a while. It has nothing on that. I didn't think it was I was prepared for the worst. We're like, this isn't that bad. We can do this. And then right now, I think we're in middle of October. The weather's beautiful. So I grew up as a little kid before I moved to LA at 9. So I remember 9 years of my life in New Jersey. So the 4 seasons, I really like that, missed that a bit. But I think it comes down to a couple things. Number one, obviously, the weather in Southern California, you're always going to hear you cannot beat that. That is true. And I think I used that as an excuse for a long period of time to justify why I was paying these high taxes that were supporting a lot of things that my wife and myself didn't agree with. But I think after COVID, there was just this huge shift to where things just started getting really unsafe, which reminded me of the time as I grew up there in the late 80s and early 90s, gang violence, people getting held up on the streets. And those are the things that started to happen again. And when I started feeling unsafe for my own safety, my friends, my wife, my family, that was kind of like the toll that ticked, that I was just like, okay, it's time to get out of here. And then obviously being in wealth management, I looked at all the no income tax states, Texas, Florida here, and it just really came down. I'm not a big Texas guy, a little too flat for me. I don't like heat and humidity all year long. So we came out here. It's an hour and a half to New York, which we go a lot. We can get back to California in a few years. But I think it came really down to the people. We love the people. We made a lot of great friends like yourself, Brian, a lot of other people that we're meeting. And I think the core values that we have were really in alignment with probably the most, at least in Williamson County, as far as I could say, the majority over here.
Well, I love that. It kind of sets the stage too, because things we're going to talk about today, people are going to want to understand not only how to build their wealth, but you're much bigger than that. And you talk about faith and you talk about all these other things that I think are interwoven. I always share, if you don't have all those parts of your life going, man, you're missing it, right? If you go make all this money, but you don't have your faith right or your relationships right and your health right, you missed it. And so I wrote down your mission because this stuck out to me. And you probably know this, but your mission is to help mentor anyone who is willing to put in the hard work to build their own business and invest in a way that secures their financial future. Dude, I that resonated because mentors in my life have helped me get to places I never could have gone. But tell me about that mission and what that means to you, because that to me, that kind of showcases who you are, because you show up and give value over and over.
Yeah, well, you know what it is, Brian? I've been in wealth management my whole life. I just kind of fell into it in college by mistake. It's not anything that I planned on doing. Got an internship and said, okay, this might work, and just kind of went all in on it. But, a lot of people, when they come up to me, especially about 13 years ago, I started getting on television once or twice a month. They come up to me and, always the question is, well, the first thing is, what stock should I buy, right? It's going to be that home run they're looking to make. But then after that, what did you do to get to where you're doing? What do I need to do to start to create wealth? And so I had to be honest with them. I came from a very poor background. I didn't know anything about the stock market, or, no one in my family ever went to college or owned a home or anything like that. And so for me, I've made a lot of great investments, fortunately, in real estate and stocks. However, I sold my first business that I started about 3 years ago to a publicly traded company that I started from a bedroom with credit card debt. And look, I didn't make hundreds of millions of dollars, but for me, it was life-changing money that I sold for. And the fact that I was able to create that as somebody who came from nothing in this country and then sell that for several millions of dollars from scratch was really what allowed me to kind of get to that next level. And I've been able to help and see a lot of other clients do it. And so from that perspective, if you have nothing, yeah, you could be a great professional athlete, and I've worked with those, but that's a very, very small minority. I think today, most Americans have the ability to start a business from nothing in most cases. And if you do it the right way, you really can create what everyone's looking for, that generational wealth. And so I've learned from a lot of mistakes that I've made, that clients have made, but I figured about 8 to 10 years ago, and I would say almost 4 years ago, when I sold that business to a publicly traded company, I had Ernst & Young come in and crawl in with a microscope to look at everything I was doing. And then that was validated with a big check. That's when I felt, okay, maybe I'm qualified to go out and show other people how to do it. And I just learned, I always say I started that business at 27, making a lot of mistakes, not looking at where I was trying to go. Really, I just kind of bought myself a job. But all the lessons that I learned at the time I sold, I quantified it, and I said I probably would have made another 40 or 50 million on that exit had I have done everything that I knew at that time from the beginning. So what I try to do is get to entrepreneurs young, show them how to kind of create that roadmap so when they do exit, they're not leaving a lot of money on the table.
Man, that's phenomenal. The fact that you are aware enough to look back and go, man, 40 or 50 million left. Yeah. And people are probably going, man, I'd love to exit for that tomorrow. And they're like, how do I get my business to 4 or 5 million?
Right.
And I've heard you talk about this too. Is a lot of people are trying to build wealth through real estate. They're trying to invest in stocks and all that. But you talk about building a business.
Right.
And a lot of our listeners I know are like, man, I'm just trying to get my revenue up. I'm trying to build it to sell at some point.
Yeah.
And you talk about that. That's really the financial freedom most of them are looking for, is potentially an exit. But I want to back up, because there's probably some listeners who are like, hey man, I don't own a business yet. Like I want to, or my business isn't off the ground and all. I had some people submit questions early on. I was like, hey, if you got a chance to talk to Rob, like what would you want to know? And they're like, man, what if I had $5 or $50 or $500,000 today in this market, like real talk? Where would you start, and what would be some of your baseline advice?
Yeah. Well, I think it starts, Brian, that you've got to invest in yourself. I mean, that's maybe overused, but at the end of the day, I talk about building a business and being able to monetize that. Unless you have a skill set that you've developed that allows you to impact people's lives in a way that's more meaningful than other people, you're never really going to be able to attain that kind of wealth. And so I think today with social media and everything, everyone thinks that they can fast track that and skip over those steps. Dan Kennedy put in a strategy that I learned in my early 20s. I just kind of took it blindly and it worked for me. It's called the ACE strategy, which is authority, celebrity, and exclusivity. And he said, which is true, the first one, the A, the authority, is what's the hardest. It takes the longest period of time. It's college degrees, it's experience, it's all those things before you can then become that celebrity that everyone knows about, and then you become so exclusive that everyone's trying to knock down the door. So I think that authority, what most people want to skip, that's what you have to invest in. Now, today, you might not have to go the traditional college route that I did, but you do have to invest in yourself. And I know you talk about the competitive edge, really building that competitive edge for yourself so you're able to stand out in a crowd. And I think too many people go away from that. So investing in yourself, I'd say, is the most important thing to do with that money.
Let's go deeper on that, because I know we align on this. And people have asked me, and I said, for me, 7 years ago was the first time I invested $10,000 myself. I thought it was massive. I was like, holy crap, put it on a credit card. And I've told the story of, I was nervous.
Sure.
So it's like, man, this is the first time I really put money behind something, not paying $99, not like $300.
Yeah.
It was real. What have you done as you look back, or you've seen people do, that if they're listening, they're like, okay, where should I invest in myself? Where does that start? What could that look like for people?
Yeah. So, what I always say, I break it down to 4 things. It's not 3. I know 3 is really popular, but it comes down to 4. It's focus, clarity, execution, and accountability. So the first thing is just, what's the major focus, right? So, okay, I want to do a podcast and become a great podcast person versus I want to do a podcast and I want to be a water salesman and solar and all these things. And I think so many people have zero focus. But then once you get that focus, what is that clarity, right? Okay, I want it to be the competitive edge, dealing with entrepreneurs, this age, this revenue, and here's how I'm going to impact them. And so what I would say is, and then you got to get to execution and obviously having some accountability to make sure you stay on track. But the first thing would be understanding what area are you trying to make that impact in, and then dialing in that clarity. And then what I would do is tailor all your experience, your mentorship, your education, certifications, all towards that. And so you have to narrow that down. I mean, I think, look, I'm one of those few people, and I was talking to Nick Hutchison yesterday, we both know. Yeah. He still believes it, which I was great to hear, because I'm an old guy now. I'm 49, Nick's 29. He still believes in the traditional 4-year degree for the same reason I do. I think, look, when you're 18 years old, very few of us know what the hell we're going to do. I don't know if you knew.
I did not. I just played soccer. That was it. That's all I knew.
Exactly. So I think, like, coming out of high school at 18 to go into college and get that foundational ability to, obviously the STEM stuff, but at least learn how to learn, I think, is very critical. And so from that standpoint, if we're talking to younger kids, I always try to get them into that 4-year degree. But from there, I went on to go to graduate school, but I don't think that's necessary these days. There's so many schools, even like Wharton or Harvard or Yale, that have executive programs now that you can go with. YouTube is free. So once you figure out what you want and you have that ability to learn and the knowledge of how to scale that, you can then go out there and kind of self-educate yourself at a much lower cost, I think.
Hey guys, it's Brian here. I hope you are enjoying the show. By the way, if you're an entrepreneur or a solopreneur looking to grow your personal brand, make a bigger impact, maybe increase your leads and grow your revenue, let's help you get started today by connecting up with my friends over at the Brand Builders Group. You've heard me talk about them, but if you're new here, this is definitely the first step to get you started in turning your reputation into revenue. Head over to freebrandcall.com/Brian Covey. Again, to set up your free brand call, go to freebrandcall.com/Brian Covey to set up a free strategy call with one of the team at Brand Builders, and they will dive into your specific goals for how you want to grow your personal brand. I can't wait to hear how it goes. And you mentioned clarity. That is the word I continue to come back to. I know in my own cycles, like when I'm not clear about where I'm going, what I want to achieve, I'm like, I'm going to try this, I'm going to try that. And you just get, as Rory Vaden would say, diluted focus gets diluted results. And I love that you shared that, because many people are like, do I get a coach? Do I join the mastermind or go to the events and all that stuff?
They do it all, and they have no idea, which ultimately do nothing. And
you see the same ones there. And I went to an event last week, and I love your take on this, because you speak at a lot of these events. And I listen to what you share, because it's unique. A lot of people come in, you talked about authority, right? Yeah. Like you have an authority, you have results. And I'm there and I asked a couple people, hey, what's your intention? What are you here for? Man, a few people did not have an answer.
No idea.
They had no idea. Yeah. And I was like, well, do you mind if I provide some advice? Because like I'm only doing 2 events this year personally myself. And I was like, I can tell you exactly why I'm at this event, but that wasn't me a few years ago.
Right. And I don't think it's most people. I didn't start out that way. And I think, like you said, I mean, time is our most valuable asset. And so I look at every single, even being here, right? You want to make sure that every minute that you're spending, you're going to be able to maximize that, and it's going towards your purpose and goal of what you're trying to achieve. And so I feel like a lot of people, you mentioned it, show up at these events, they're getting a lot of good information, but then they go home and they do nothing with it because they don't have a specific purpose. And so like you, I don't really attend many things anymore. I used to do a lot, but there could be a situation where I might buy a $10,000 or $5,000 ticket just to go and listen to one speaker and then leave, because I know within my mission and roadmap of what I'm trying to accomplish, that $10,000 listening to that one thing, asking that one question to a speaker, I might be able to monetize and maximize 20, 30x that. Yeah. But most people don't have that clarity, so they get a lot of information, sounds great, they get hyped up, and then go back and do nothing.
Yeah, and I'm sharing with the audience because I've been there, right? And sometimes I go, hey man, here are the lessons. Let me share with you. And this was a high-level conference, high-level people. But then on the other side, I want to make sure I mention there were some people there very intentional.
Sure.
Like, I'm here for this one reason.
Right.
I'm here to meet this one person and what it was. I want to get your input because, we've had some social media posts lately. You mentioned social.
Yeah.
And we talked about some people, and you went into talking about IRAs lately. You know, and I had a Roth IRA as a teenager. Thank goodness I had somebody in my life that was one of my dad's friends. My dad was a psychologist, so he didn't know about the money side of things as much. I had a friend, and his dad was in financial planning. He's like, you got to open a Roth, right? So talk about a Roth, and for people today, an IRA, where you see that fitting in for some of these younger, newer, maybe entrepreneurs.
Yeah, so I think, once you've invested in yourself, you've obviously got to go a little bit beyond that. Yeah. And so I think most people, once they get that first $5,000, $10,000, like you were saying, they're saying, okay, look, I've got a career now, or I've started a business, I've invested in myself, but I've got this extra money that I want to start saving. And I think that's, what I teach everyone is both personal financial literacy and entrepreneurism, because I've seen people make a lot of money and blow a lot of money. And so unless you're doing those two things in tandem, you're not going to really get to where you're trying to go, which for everybody that I've ever worked with is, at some point in time, I want work to be optional. I want to be able to take the money that I'm making right now on a cash flow basis that I'm getting from my business, but not have to worry about showing up every day, traveling, doing a million podcasts, sales pitches, cold calls, whatever it is. And I want to be able to rely on this passive income portfolio to be able to take that place. So now I just show up and do things that I want to do. And so the way that you do that is you start very early on, $50 a week, whatever it is that you can afford, in building that passive income stream. And so when you think about that, okay, you've got $5,000-$10,000. It's not, the first question is not, should I buy real estate? Should I buy stocks? It's what structure or entity should I put this into? And for most situations, and I can't give blanket advice out there, but the vast majority of times, if you qualify for a Roth IRA, which is about $150,000, $228,000 or below for a couple, which most people don't start making over $228,000. You could each put $6,500 into a Roth IRA. You could open that at Schwab, Betterment, wherever you want, and you can invest in anything that you want, mutual funds, ETFs. The great thing about it is all the money that you build in that Roth IRA, once you turn 59 and a half, you could start to take out tax-free. Yeah. So there's not really much out there that is tax-free. So you put, I remember my first Roth contribution, one of my few, because thankfully I started making a lot of money early on in the business I was in. I bought, I think it was 125 shares with it was 5,000 at that time, of Amazon. And this was in 2001, 2002. Wow. And I haven't touched it. It's still my biggest position. It's grown really well. So the nice thing about that, when I sell out of that, it's going to be all tax-free. So I would tell people that are young especially, open up a Roth, invest in the assets, not the real safe stuff, because that's not what you're trying to do there, that you think you're going to have the biggest growth with. I
love that. And that's real practical advice that most people are not getting.
Right.
Everybody's wanting to skip the steps, I find, right? They're like, man, forget the Roth. Like, I may not make $1 million yet, but I'm down here making 100,000. Let me just skip. I'm going to go buy real estate. I'm going to do all these things. I'm like, guys, let's back up. And I love that you share this for people listening. When you start teaching them the basics of that and they move past, let's just say a Roth, and they're in that bucket. Yeah. What should they start doing once they're fully funding that? What would be a logical next step for them?
Well, if they're an entrepreneur, I'll also tell them to do the Roth IRA. The Roth IRA, you actually don't have any income limits. So if you're making $2 million a year, you could still put up to $22,000 in the Roth IRA. Nice. So a lot of people go into these insurance things. They're saying, I don't have $6,500, but if you're a married couple, you can actually put $44,000 a year into the Roth IRA. If you get past that, you could do a profit sharing plan. So just those are some basic things to look at. What I would say though, what I talk about in my book is you really have to have different strategies for your money. In behavioral finance, they kind of go against that and they say that's mental accounting. But someone who my undergrad's also in psychology, I understand one of the biggest challenges that most people have and why they don't succeed is the mental aspect of investing, right? We're buying high, selling low. Why? Because when everything feels good, when everyone's doing good, we want to buy more. 2008, 2009, when everyone's scared, we're starting to sell at the bottom, right? So what I would tell, most people, once you set up those accounts, what you really want to do, I say work right to left. Figure out where are you trying to go. So the first thing I talked about was work's your work optional number. Mm-hmm. So if you say, hey, my lifestyle really costs me, core lifestyle, about $200,000 a year. That's what I need. If I can build up something to where that's money's coming in, then a lot of stress is going to go away from me. So, okay, you figure that out. I talk about this in my book. You reverse engineer that 5% rule. That's about a $4 million portfolio. So when you think, okay, I need to get to 4 million, if I can get 8 or 9% a year, that'll kind of give you your number of where you need to go. For most people that are working a regular job, you're going to find out very quickly the amount of money that you have to put away is very challenging, which is why I talk everybody into being an entrepreneur. Start maxing out those things. But then what I do with people is say, okay, we can put, let's call it $20,000, $30,000 a year away once we're making a couple $100,000. Okay. If we can do that for 15, 16 years, what if we can dump another $1.5 million or $2 million into it from selling all or a portion of our business? And so what most entrepreneurs don't do or aren't told is you can do both. Max out the IRA, do all those things, but also start building that business up as an asset. And that's kind of what I did my whole career in wealth management. My deal was, when you talk about competitive edge, I thought, Brian, like, everyone could tell you to go in a Roth IRA, everyone could tell you to buy this stock or ETF, but what's the value that I could bring to the table? So my clients were either entrepreneurs or professional athletes. All the professional athletes became entrepreneurs because they didn't want to,
that's right,
leave the football field primarily and go and work for people. And so what I started showing them is, how do we build that business as an asset, either for internal succession, selling to a strategic, going public, selling to a publicly traded firm. And so the vast majority of the time I spent was showing them how to build that as an asset. And so I always tell the story, my largest client when I sold my firm, who had about $130 million invested with us, the year before he sold only had about a $200,000 portfolio. For him, it made sense to put and he was maybe 40 when he sold, all the money back into his business, because we could see he was hitting certain milestones. He had government contracts where I gave him non-traditional advice, not to max out the 401k, not to buy stocks or real estate, but be all in on that business. And ultimately, when he sold, it was then obviously, I think for most people, over $100 million is life-changing money. So, I think, look, again, I'm biased. I think everybody can be an entrepreneur, should be an entrepreneur. It starts with a side hustle or whatever it is. But investing your way to wealth is a very long path. It's very challenging without that big lump sum distribution that comes in from a business asset that you're selling. Either that, or I tell a lot of people, get in with a good company where you can get equity, help ride that, be part of building that. And I've seen a lot of multimillionaires made that way as well. But you have to have equity ownership.
Yeah, I love that you talk about this, because you mentioned something too that I talk about quite a bit, which is the entrepreneur, right? And that's been most of my career. If I didn't go actually start the company, but I've come in, and whether it's an equity piece or just being part of a company,
right?
I'm like, wow, that's a good role for me. Like I recognize my number 2 spot. For everybody, sure. Talk about that today, because some people maybe they aren't cut out. They're not going to go do the full blown entrepreneur, but they're a phenomenal entrepreneur. And I think people miss this today because like, I'm just going to do it myself.
Yeah, it's not that easy. It's not that easy. And the truth is, I started looking, later on in my career, when I was about 12, 15 years into it from building my business, I started thinking, you know what, if I would have just taken my book and rolled into something that was bigger and established, I wasn't quite sure that I would have made the right decision, or I would have made the same decision again. That changed after time. But I think there are some people, Brian, that just, they don't want to do what it takes also. Look, as an entrepreneur, there really is no vacations. You might go somewhere, but your mind isn't there. You're halfway there. I heard you on a recent podcast talking about a mentor who told you, be where your feet are. And I think probably one of the biggest regrets I have as a parent, there was a lot of points in time, especially my daughter was born during 2008. And during 2008, I had a wealth management firm where I was only compensated by 1% of the assets that we managed. And so it was a pretty scary time. And there was a lot of points in time during her life where I wasn't where my feet were. So to look at the opposite end, a lot of people, oh, Rob, they see the success, but they don't see the times where I wasn't where my feet are, and I missed birthday parties. I miss, even though I was there, I just miss being present. And I think a lot of people maybe shouldn't sacrifice that, don't want to sacrifice that, which is okay, which is why I say an entrepreneur is fine. At the end of the day, though, I do believe you have to have equity, because if you don't have equity, you're not going to get that upside for your efforts. And I also believe, probably how you are, Brian, a lot of the traits that you need to have as an entrepreneur, you also have to have as an intrapreneur.
Yeah, very much.
You're just able to monetize those and maximize those more, going into an ecosystem that's already established for you. And so I'll give you a couple of examples. One was I'm part of this membership, I think you were talking about, called Club 33 at Disneyland.
Oh, yeah.
And I just told the story. So kind of a cool thing. They give you a private tour guide every time that you go. And the point of this story isn't to talk about that, but I had this tour guide for about 3 years. He was in college, young kid, and his goal was to get out and get into marketing and sales for ESPN, which is owned by Disney. And so he would ask me, like, do you think that's the right thing? And I said, you know what? His name is Adam. I said, look, Disney's a good company, but I think the best years are behind it. And I said, for you to really maximize your potential, you need to get into a company that you can get into equity. And so I said, why don't you look at some of these tech companies? He's out in California. The short of it is, I talked him to going working for a company called CrowdStrike, which is a cybersecurity company, pre-IPO, before they went public. Him and his wife actually went and worked for there. He was 26 years old when the company went IPO, and it was several millions of dollars that his pre-IPO stock became worth. So he was a multi-millionaire at the age of 27. Great marketer, but starting a marketing agency on his own at 25 probably wouldn't have gotten there. That's one. The second I'll tell you is a client of mine for 16 years. He was 30 years with IBM. And, he made some money with IBM shares, but I said, Lou, I think now's the time to step out, take that experience into private equity to some of these technology companies who need that senior experience. And Lou probably made about 10x in 4 years what he made in IBM over that 30-year period. Wow. By taking that skill set to a company where he was able to get pre-IPO equity. So the idea is, understand what you're willing to do, not willing to do, understand what your talents are, and see, is there an opportunity out there where I can get equity, I can get in early enough, and the contributions and sacrifices that I'm going to make are going to take me further with this plan than they are my own plan. For a lot of people, that's the right answer.
Yeah. Well, it's back to what you said earlier about the authority.
Yeah.
Like, once you actually establish what you're great at and continue to get better, you bring value in, you get equity, you do those things. And I just don't think that's talked about, right?
No.
Everybody goes and wants to go the fast track of, I'm going to be an entrepreneur on social.
Right.
I'm going to crush it. And I think for me, that's what you bring, is a unique perspective, that people need to hear these stories, that these are real people that could be them.
Yeah. Well, yeah, I mean, that's the benefit I've had also is I started at 22 working with multimillionaires. So I've always worked with wealthy people. They've all made their money differently, but it always came, professional athletes are professional athletes. God bless if you can go out and do that. Absolutely do it. That's the one time I say skip college. If you can get a contract, college is always going to be there. Go ahead and go for that. But everyone else, when I look at the common denominator, it either came down to they were entrepreneurs selling equity, and sometimes it was a family business that they took over, or they were corporate senior level executives that they were able to get equity from the business that they were working with. I haven't seen anybody do it any other way. Yeah. So if that's the reality, I always tell people, be a corporate executive, entrepreneur, professional athlete, and you're going to get to where you want to go.
Figure out those. Yeah. Well, you shared something earlier, and this is, I know when I was prepping for this, we had our first daughter in 07, and we had our first son in 08. Okay. So I felt like
you were right there.
I remember I was like, man, and in the mortgage business, wealth management, all that, you wake up one day like, hold on, I really don't have a job anymore.
Right.
Is my company okay? What's happening?
Yeah, it's scary.
So I'd love to ask you this, because people are putting this correlation out there today of like, man, we're headed for this big collapse. All these things are going to have 07, 08, 09. We're going to see it all again.
Yeah.
What are you seeing, and what maybe are some of the lessons we could have learned back then that could apply to today? Yeah,
great question. So, there's a saying that says history rhymes, but it doesn't always repeat itself, right? And so I think there's always a lesson to be learned. I learned a lot from 08 or 09. I learned a lot from COVID. I learned a lot from 9/11. I learned a lot from the dot-com crash. And a lot of those lessons have helped me become a lot more secure going forward. However, every situation is different. I came into the market in 1998. We're almost the same age. We really haven't seen high interest rates during our period of time. They've been going down since the late 90s all the way to about 2 years ago, and now we're starting to see the opposite. impact of that. And one thing I always, teach all my coaching clients, my academy members is understanding the correlation between the 10-year bond interest rates and how that ties to the economy, because everything goes back to that. And so I think we're at a point in time right now, because interest rates are rising, everything that helped us over the last couple of decades is now going against us. And so trying to understand where the fallout is going to be, where the opportunity is going to be, that's where we're all looking now. And so I feel like, look, I'm not one of these people that's in the camp of the world's coming to an end, especially, there's a lot of talk out there about housing crashing and all those things. And I think because most people are tied to housing, either they own a home or want to buy a home, that's kind of important to understand. So I'll maybe just talk a minute about housing and what that looks like. It's a different time now than it was in 08, 09. One, I would say they had those liar loans that you're probably aware of.
Oh, very much. Yeah.
You just breathe into a mirror, say how much. I make $2 million. Okay, cool. Here's a loan. And we all kind of know how that ended. Didn't end really well. So the amount of equity that was in homes during those times, the ability to repay during those times, wasn't anywhere near what it is today. The vast majority of homes today, people do have equity in them. They're fixed over 55% at interest rates under 4%. So that's a different dynamic. Also, the lenders behind them, they're not diced up into millions of pieces and collateralized. So I feel like just the foundation of housing today is much different than it was back then. Also, what I'll tell you, I invested a lot with Blackstone during 08, 09, who was an institutional buyer who never had single family homes, KKR, prior to 08 or 09, who came in a very big way and still remains today. You also have the millennial generation, which is the largest generation in U.S. history. This all sets the stage for you now have much greater demand because you have institutional buyers, millennials that want to buy a home. You have people that are in their homes right now at very low historical interest rates. Yes, we had price appreciation. It's not super crazy. Now, when you start talking about these homes that are 10, 20, 30 million, that's a whole different ball game. But when you talk about the average U.S. home price, even up to $1.5 million, I don't really see anything too bad there. The opposite of that, though, is commercial real estate. So I've been talking about this for a while. You saw First Republic Bank fail. They were a big backer in there. There's companies like Synovus, Truist that are still out there that I think are going to run into a lot of problems, not to throw anyone under the bus, but their balance sheets are public information. You could see where they're lending. So when you think about what's happened in COVID, okay, well, a lot of people said, and I was one of them, I don't want to be in a high rise anymore in Los Angeles. I want to be away. Now I'm away in the country. I want to have some property. I don't want to have to worry about if we do have another lockdown that I can't go outside without driving my own car without wearing a mask. And so a lot of people moved away. Remote work became a bigger thing. Hybrid work became a bigger thing. And so when you think about that, do people really need as much Class A, Class B office space as they did before? The answer is no. My wife and I are in New York about every 6 weeks. Every single time I go back there, there's more and more space that's available. And so when you start thinking about that, commercial real estate's been hit with a triple whammy. You've got higher interest rates, higher vacancy rates, you've got lower valuations, and actually more than triple, quadruple, you've got less liquidity because a lot of the banks that would refinance that are going away. Unlike 30-year mortgages where you lock in your rate, these are usually 5-year rolling notes. And so you've got about $3 trillion in total debt. About a third of that needs to be, refinanced over the next 2 years at a time where the properties don't look as attractive anymore. So there's going to be an issue there. So if you're directly in that, I'd be really scared. But what I learned from 08 or 09, Brian, was I was telling people out in Arizona, especially in 06, stop buying residential properties, get out, sell your properties. I got a lot of my investors out. I was wrong for about a year because prices still went up. Ultimately, they peaked in late 07 and crashed well below that. But what I didn't recognize was the wideness of the net in terms of how that contagion would spread into everything, that all asset classes would come down, even good asset classes. And the lesson learned then was, even if it was a good asset class like Procter & Gamble stock, when people need liquidity, they don't necessarily sell what they want to sell, they sell what they can sell.
Yeah.
And so the question is, how big of a liquidity event is this going to be? I don't think it's going to be as big, But at the same time, I don't want to be one of those people that whistle past the graveyard. So for the last year, I'm telling people, get your cash reserves up. Don't take on unnecessary debt. If you're a business, don't take on new space. Only do the core hires that you need. Not that you retract and go into a bunker, but you just want to have what I call optionality. Have some extra cash on the balance sheet as an investor, as a business owner, because when things do hit the fan, whether it's real estate that you might have been looking at, whether it's that really great employee that you couldn't get 2 years ago but might be on the market today, it's other businesses that are now close to insolvency that if you have a business you can acquire through inorganic growth. If you have that cash today, cash really is king today because you're getting 5.5% just to sit in a money market account 2 years ago that was less than 1. So cash is my favorite asset right now in this market.
Well, and I remember you sharing this over a year ago.
Yeah.
And I started making moves. I'm like, okay, if Rob says this is coming, like, let's prepare and get liquid. And everything you said has just happened. We've acquired teams from other companies in our mortgage business that we're not paying what was paid a year and 2 years ago. One company actually just went all the way under. And so we're acquiring, and this at one point was like a $3 billion a year mortgage company. And so everything you're saying is there. People are consolidating offices. They're not going in. And so they're tightening their belts everywhere. And so the people that made the moves are making it happen. I want your opinion on this because this is what we get asked, right? In the mortgage space and real estate. I was like, man, is it a good time to buy? Is it not a good time to buy? And I was like, it depends. Right. So I'd love your take on this because I think a lot of people are getting bad info, like rates are so high, no one should buy.
Yeah.
Well, I bought my first house at over 7.
Yeah.
It wasn't a bad deal.
Right. Yeah, I bought my first house, I think it was at 7. I had an assumable rate mortgage, and I was actually able to, it was a townhouse. I was actually able to sell that house because rates got close to 8, and I had an assumable rate mortgage.
Yeah.
So it looked more attractive at that time, and I did okay on that house. So look, historically, rates aren't that bad. Yes, they're a lot more expensive than they were 2 or 3 years ago. But I would say this is more the norm. 5.5%, 6% to 7.5% is really what you should expect over time. So, I saw a couple of posts. I saw someone posting actually yesterday telling people buy now because in a year and a half, rates are going to be back to where they were, and then you can refinance, which untrue. I don't. For a lot of reasons, I don't think rates are going. You're in the mortgage space, but if I just look at they're not going back there anytime soon. So the question is today, if you look at 6 to 7.5%, can you afford? First of all, the house doesn't make sense. Is it where you want to be? And I would always tell people there's a difference between your primary home and in investing in that versus investment properties. So when I look at residential real estate as an investment, today it doesn't make sense to me because I get almost 6% for no risk and full liquidity.
Right. You're
not really getting that in residential. But as a primary home, look, you get the tax benefits. Rental prices continue to stay stubbornly high. The Fed, when people talk about this hope of interest rates coming back, well, that really is going to be dependent on 2 things. Number 1, unemployment. Number 2, inflation, which is the only 2 things that the Fed worries about. Inflation is going to be very, very stubborn because the core part that is not moving down right now is housing prices, rentals, and services. And services are things like insurance prices and so forth. Those 2 aren't coming down anytime soon. So my biggest worry, and why when I first came out here, I'm like, maybe I had the same thing myself. I had sold a property in Newport Beach, and I'm thinking, do I buy now? And the truth was, Brian, when we bought in January of this year, I was like, I know I'm probably buying at a high price, but what I'm more concerned about is rents getting away from me and then having to rent and these prices staying sticky and not moving anywhere and interest rates. I thought I was at a high interest rate in January. Well, now it doesn't look that bad.
You look good buying that.
Compared to what I locked into. So I think, look, if it's somewhere you really want to be, you're going to be there at least the next 7 to 10 years. I think buying a first home, especially for most people, is still super smart. I bought my first home at 19. Best investment I made. I rolled to the next house, to the next house, to the next house. It's forced savings. It's something that at the end of the day allows you to put your head down at night on the pillow, know that there's an asset that you own. I think for most people, and they see that mortgage statement, I paid this much off. It's a good first lesson in investing for most people is buying a home. So if you're buying a residential property for yourself, I'm not going to say don't do it today.
I love that. And I think that's the advice we've got to get out. And we're all combating this negative news and other social media influencers would say is like, your primary home is not an asset.
Yeah.
And all these, and everybody's like, I don't know what to do with all this information coming at me.
I hear a lot of that nonsense, and I always talk about just transparency and understand we all have a conflict of interest. I have it, you have it, which is okay, but it's just understanding what it is and making sure that understanding your own conflict of interest and not giving information to people that is more self-fulfilling and not helping other people, because at the end of the day that stuff comes back to you. And so when I hear stuff like that, don't buy a home but invest in my REIT that's going to pay you 2% a year, I'm not really a big fan of that kind of stuff. So I think that's
well, that's why people need the truth. That's why I follow your stuff and I'm engaged with it, because I think for a lot of people, they're listening to all this noise that's out there and they can't make decisions. What I always say is, man, just run the numbers. In the end, pull your emotion out as much as you can.
That's exactly it.
And look at numbers. And, we've actually had a couple deals this year that we passed on. Recently, that I'm like, to your point, there's other investments today that I go, well, less risk. I'm just not going to do that today.
That's the way we have a saying that data kills emotion, right? So someone could be really emotional about something, but I've always found if I could break it down and show them side by side, this versus this, when they see that this benefits them, they're usually going to make the right decision. But that's the challenge that you just said. Today, you're looking at maybe a real estate deal or whatever it is, and you're passing on it. Why? Because the alternative is there, and the alternative is risk-free. The alternative is liquid, and it's 5.5%, 6%. So why did NFTs do so well? Why did all this crap do so well? Watches, sports cars 2 years ago, there was no alternative. So the risk of putting your money in a savings account then was nothing because you got zero. But today it's like, okay, on every $100,000, every $1 million, that's $5,500 or $55,000 just sitting there that I'm getting, not zero. So maybe that's not such a bad thing to be. And so people are becoming more concerning. And that's essentially what the Fed does, is they make those alternatives more attractive, so that way the asset bubbles that were being created, like NFTs, like cryptocurrency, get popped before they get out of control.
That's a great explanation that most people can't articulate. And so rewind that back for most people. Rewind that, because understand that.
Yes. So the Fed only has one tool, which I think everybody should know, and that's monetary policy, which is raising interest rates, lowering interest rates. That's all they can do. Things like fiscal policy, tax cuts, benefits, that is Congress. And we've seen over the years that's much more difficult. But the Fed independently can raise and lower interest rates. And so if their mandate is two things, which it is, full employment, making sure that unemployment's somewhere around 3.5%, 4%. They want people to have jobs. And then inflation is their other mandate, which they want that to be about 2.5 to 3%. What they can do is raise or lower interest rates. So when you think about lowering interest rates, what does that do? Well, today mortgages are 7%. If they went back to 3 and I was able to refinance at 3, well, what does that do? Well, same home, same valuation, my payment goes down significantly. There's thousands of dollars that come into my personal balance sheet that I can now spend on goods and services. So that spurs the economy, more money into the consumer pocket. Yeah. Well, the same thing, if I go to buy a new house, if I've got credit card debt, if I have student loans that are revolving, if the Fed raises interest rates, that's more money that comes out of my pocket that goes to banks and paying debt, less that can go into the economy. So from a consumer standpoint, that slows down spending inflation on things like used car prices, sure, which you see coming down. But what it also does is it ties to assets. And so when interest rates go up by the Fed, your money market accounts, your short-term bonds, those rates go up. Money market accounts today are 4.5% to 5%. Mm-hmm. 2 years ago, they were 0. So parking your money in money markets 2 years ago, you didn't make anything. So people said, come invest in tech stocks that'll grow in 3 years. Invest in cryptocurrency, NFTs, and all these things. And people said, well, okay, I'm not getting anything here anyway. So the corollary happens, though, when you can get something and you look at a real estate deal 3 years ago, that was a 4 cap, 5 cap, you're getting 4 to 5%. Pretty attractive. I'm getting 0 over here. But now, I don't know, my T-bills, my short-term bonds, my money market's 5.5. I can get out of that whenever I want. 0 risk, where, I might have to refinance this commercial debt. We might lose a tenant. Valuations could come down. If I can get the same return for 0 risk, maybe I don't want that. And so when people stop investing in these things, valuations come down. At the end of the day, it's supply demand. You have more supply because more people are looking to sell, less demand because more people are sitting in money market accounts. And that's what I call it optionality. And so I try to convince everyone a year and a half ago, put more money into cash. People thought I was stupid. I said, because rates are going up, and that'll give you some optionality when stuff gets tough. You'll be the only one sitting there with cash, because I always say opportunities come at the time where the least amount of people could take advantage of them.
That's right.
Not when everyone's flush with cash. So good investing is counterintuitive.
I love it. And you nailed that one. I look today and I'm like, man, it's good to have these options. Like you said, we have so many options today.
Right.
And you don't have to be pigeonholed. That's there. So I wrote down this quote when I was preparing that kind of reminded me of you a little bit. It said, wealthy people spend money to save time.
Yep.
Most people spend their time to save a little bit of money.
Yeah, it's true. I mean, I said, the older I get, the more I learn that time truly is your most valuable asset. So I don't mow my own lawn. I don't spray my own weeds. I don't do pest control. Could I do it? Probably. But there's people who could do it more efficiently than I can. And by not spending that time doing that, it comes down to two things. I'm either spending that time making money to improve the lives of myself, my friends, my family, or I'm spending time with my friends and family, which is way more important than going out there and cutting the lawn. And so, look, I know that statement in and of itself has a degree of a high-class problem to it, right? A lot of people are saying, well, I got to cut my own lawn, and that's fine. But the idea is the mindset always of, where am I trying to go? I think there's a lot of things that we all do at the beginning of our career or whatever it is. Like when I first started my own business, I was washing cars for my friend on the weekend to be able to keep my business afloat. You do what you have to do, but I always, when I say work right to left, I always knew where I wanted to be and what that lifestyle looked like. And so when I was able to hire my first assistant, when I was able to pay someone else to wash my car, to do landscape, I did those things because I knew my time in doing the things that I was doing was much more valuable on an hourly rate. And so I did that. So I would say, like, if you're doing those things today, this isn't to put you down or like you have to do them. I did them, but understand where you're trying to go. And if you do that, and if you have that mindset, as you start to grow, it's just going to expedite that path for you.
I love it. And I know we align. When I started as a loan officer, I was still coaching soccer,
right? Supplemental
income. And so I was like, well, how did you get to there? And it's like, you have no idea of the amount of times. And then I would go back to those things because over time, and a mentor shared that very same thing that you shared, Rob, was, hey, there's certain things you need to bring on an assistant. Like you're doing all these things. Imagine if you could scale this, right? They go, well, what if you had someone cut your lawn? That'd be time with your kids. And like, started to make sense. So people listen out there, just listen, because this doesn't happen overnight. It's not something you got to do right away, but there is a point in time where you said like that hourly rate, I started thinking, if somebody can cut my grass for this amount of money, but I can go out here and do things I love to do or generate more revenue. Game time.
Yeah, and I got a lot more grass here than I had in California. I'm glad I got somebody else cutting it for me. It would take me weeks to do it.
Oh, my friend, I know we could jam forever. This has been a joy, and I love the way that you just show up with your faith and your family and the things that you bring in. I would tell you, you're a breath of fresh air because not only do you have the substance and the authority, but you actually are helping people. And it's back to your mission that you brought in. I shared that earlier. And so I just want to say thank you because there's not enough people out there that I think are living that purpose and their uniqueness that God's given them, this gift and experience to give to people. So
well, I appreciate that. I appreciate you having me on here. And you know what I'll say? I had a professor at Wharton. His name's Adam Grant. Super smart guy. He's wrote a lot of books. And he told me, and I didn't understand it at the time, he said, we told the class, he said, there's no such thing as true altruism. He said, Mother Teresa, all these people, they do it because of the high that they get from it. And I wasn't always that way, to be honest, Brian, but it got to a point in my life where, okay, I made enough money. We all want more money. We all want to be in better shape. We all want to be better looking and all those things. But I got to a point where it just really wasn't fulfilling to me anymore, which is my faith really is what, and I found faith a lot. I mean, I grew up Catholic and all those things, but I really found faith much later. And it came to that point where I knew there had to be more because I just wasn't fulfilled anymore. And that combined with the ability to help other people succeed and achieve their own goals, I think that's really where success begins, is when you can get as much or more enjoyment out of seeing somebody else buy their first home or start their business or succeed, and you have a little bit to do with that. That's really, the truth for me, more rewarding than having those successes your own. So I love what I'm doing. It's not altruistic. I love having a part in making other people successful. So I'm going to continue to do that as long as I can.
So you're doing a great job. And it is addicting. And so if everybody out there listening is find what that is for you, give it away and help more people. When you help more people, the money tends to flow in and the things that you want tend to happen. And
it just happens. Amen.
Yeah, that's been awesome. What have I not asked you that if you were to have one truth or one thing that you would share and kind of pass down even to the family that you would want to leave people with? Like, this is something I know to be true, and kind of a wisdom type thing.
Yeah, you know what? I'm one of those people, right, where I hate hitting people over the head with my faith. And so I don't really want to do that, but I'm going to do that. And like I said, I believe Jesus Christ is the only way, and I've got to have to say that because that's the truth for me. And a lot of people will try to water that down and minimize that and say, oh, as long as you're a good person, as long as you're... I don't personally believe that. And so because I don't personally believe you can't get wealthy without being an entrepreneur, or there's other things I can't say it. So for me, I would really push people to read the Bible, find faith. And when you do that, and you do that without looking for something back in return, it's crazy because miraculously the world changes for you. And all those things that you wanted that you couldn't get, or the things that you have and you didn't appreciate or understand, the world of clarity just kind of opened to you. So I would kind of end it with that. For me, that's what it is.
Love it. Man, nailed it. Wow. Okay, guys, this has been an amazing episode. You're going to rewind this. I know I'm going to go back and be able to listen to this. So being in the moment, I love these because I'll go back and make notes. Make sure you like, subscribe, leave us anything that has resonated with you today that has either kind of spawned something in your heart or your dreams, or just a practical piece of advice that we gave you that Rob shared wisdom that you implemented. Let us know how we're doing with that and anything that you've actually done, because we love to see your journey continue to move forward and make an impact out in the world. I believe that's what God has called you to do. He's equipped you to do. So go out there and do that. We'll catch you on the next episode. See you guys.